Mergers and acquisitions, M&A, are strategic moves in the business world where either two companies combine their operations into a single entity, merger, or one company purchases another, acquisition. These activities are primarily driven by motives such as growth, market expansion, or diversification. From an accounting perspective, M&A transactions are complex and require meticulous attention to standards and regulations. There are several key areas to focus on when examining M&A accounting. The most commonly used accounting method for M&A is the purchase method. In this method, the acquiring company records the purchase of the target company's assets and liabilities at their fair market value. Historically, the pooling of interest method was also used, which allowed the combination of companies without recognizing any new goodwill. However, this method has been deprecated in favor of the purchase method under both IFRS and GAAP standards. Goodwill is a significant factor in M&A accounting. It arises when the purchase price exceeds the fair value of the net identifiable assets acquired. This intangible asset reflects the excess value paid, often due to brand reputation, customer relationships, or employee expertise. Goodwill must be tested annually for impairment to ensure it does not overstate the company's value. Intangible assets such as patents, trademarks, or customer relationships, which may not have been recorded previously on the acquired company's balance sheet, also need to be recognized and valued. One of the critical steps during an M&A transaction is fair value measurement. This involves determining the fair value of all acquired assets and liabilities as of the acquisition date. Following this, the purchase price allocation (PPA) process assigns the purchase price to these identified assets and liabilities, ensuring they are accurately reflected in the acquiring company's financial statements. Post-merger or acquisition, the financial statements of the acquired company must be consolidated with those of the acquirer. This means combining income statements, balance sheets, and cash flow statements into a single set of financial statements. Also, eliminating any intercompany transactions to prevent double counting. Contingent consideration, often referred to as earn-outs, is part of the purchase price that depends on the future performance of the acquired company. This consideration is recorded as a liability or equity, and any changes in its value must be recognized in the income statement, impacting earnings. M&A transactions often lead to complex tax situations, especially concerning deferred taxes. These arise due to differences between book values and tax values of acquired assets and liabilities. Additionally, the tax treatment of goodwill can differ from its accounting treatment, potentially creating deferred tax assets or liabilities. Annual impairment testing is another key aspect, particularly for goodwill. If the fair value of a reporting unit falls below its carrying amount, an impairment loss must be recognized, affecting the income statement. Acquisition-related costs, including legal, advisory, and transaction fees, must be expensed in the period incurred and cannot be capitalized as part of the purchase price. Finally, future payments based on performance milestones, known as earn-outs and contingent liabilities, must be recorded as liabilities and remeasured each period, affecting earnings. Mergers and acquisitions, M&A, are complex processes that present numerous challenges for companies. One significant difficulty is cultural integration. This can occur due to differences in corporate cultures between merging entities, including varied management styles, values, and work ethics, which may lead to misunderstandings and conflict. Additionally, employees might resist changes brought by the merger or acquisition, especially in cases of layoffs or restructuring, further complicating the integration process. Valuation challenges are also prevalent as acquiring companies often overestimate projections, resulting in overvaluation of targets and subsequent financial strain post-acquisition. Assessing intangible assets such as intellectual property, brand reputation, or customer relationships is equally subjective and difficult, leading to potential mismatches in perceived versus actual value. Regulatory and legal hurdles can impede M&A processes. Regulatory bodies may block or impose conditions on deals if they deem the merger to reduce market competition and antitrust issues. International deals face extra layers of complexity due to differing legal environments, tax laws, and labor laws across countries, which can result in costly and time-consuming regulatory navigation. Integrating systems and processes is another major hurdle. Companies often face obstacles in merging different IT systems, which can be intricate and expensive. Additionally, harmonizing operational processes and workflows can slow down business operations and negatively impact productivity. Financial risks associated with M&A are also notable. Companies often overestimate the synergies, such as cost savings or revenue growth, which the deal is anticipated to achieve, leading to missed financial targets. Moreover, acquisitions often involve significant debt or substantial use of cash, which can create liquidity issues if the expected returns are not realized. Retaining key talent during M&A is crucial but challenging. Key employees, particularly from the acquired company, might leave due to uncertainty, loss of control, or cultural differences, leading to a loss of valuable expertise. Additionally, the departure of senior executives can result in instability and lack of direction for the merged entity. Effective communication and transparency are vital in the M&A process. Inadequate communication with employees, customers, and stakeholders can generate confusion, rumors, and reduce morale. Poor management of stakeholder expectations may lead to dissatisfaction and loss of trust, further complicating the merger. Integration of products and services is another critical area. Merging companies may face the issue of product line duplication, which can create market confusion and necessitate restructuring. Poorly managed integrations may disrupt service delivery, causing customer dissatisfaction and potential loss of business. Mergers and acquisitions, M&A, are complex processes driven by various critical aspects that ensure the success and smooth transition of the companies involved. One such vital aspect is due diligence, where the acquiring company conducts an in-depth investigation of the target company's financials, operations, legal matters, and other significant areas. This investigation can be categorized into financial, operational, legal, and tax due diligence, all of which help in assessing the true value of the target company and uncovering any hidden liabilities or risks. Another important aspect is deal structuring, which involves deciding between stock and asset deals. In a stock deal, the buyer acquires all shares of the target company, including its assets and liabilities, whereas in an asset deal, specific assets and sometimes liabilities are purchased, potentially reducing risk. Additionally, payment methods can vary. Common structures include cash transactions, stock swaps, or a combination thereof. Stock-for-stock deals are particularly typical when companies aim to conserve cash or leverage the buyer's valuable stock. Financing the deal can involve significant debt, known as leverage buyouts, or equity financing, where new equity is issued or existing stock is employed as currency. Financial risk is introduced especially if the acquired company does not generate enough cash flow to service the debt. Strategic buyers, usually industry-related companies seeking synergies, market expansion, or competition elimination, differ from financial buyers such as private equity firms, which focus on short to medium-term returns by improving and reselling companies. Hostile takeovers represent a more aggressive approach where the acquiring company attempts to purchase the target without board approval by directly approaching shareholders or attempting to replace the board. Defense mechanisms against such takeovers include poison pills, golden parachutes, and white knight strategies. Synergies, both cost and revenue-related, are critical as they enable reducing operating costs and increasing combined revenue through various strategies such as cross-selling or entering new markets. Employee and stakeholder communication is paramount during the M&A process to ensure trust and a seamless transition. Offering retention bonuses can help in retaining key employees throughout the transition. Post-merger integration (PMI) is arguably the most crucial aspect, requiring meticulous planning to align business processes, technology, teams, and company cultures. Integration issues often lead to inefficiencies and missed synergy opportunities, underscoring the need for a dedicated integration team. Breakup fees serve as a penalty if the deal fails due to reasons such as the target company accepting a better offer or failing to gain shareholder approval. Finally, anticipating market reactions is essential, as the announcement of an M&A deal can significantly impact the stock prices of both companies involved. Competitor response can also influence the market dynamics, as they may launch their own acquisitions or strategic adjustments.